Exchange-traded funds versus mutual funds. Two popular investment vehicles that often confuse beginners. While both allow you to invest in a diversified portfolio of assets, they operate quite differently. Understanding these key differences will help you make better investment decisions based on your financial goals and trading preferences. Let's start with the fundamental difference. Exchange-traded funds, or ETFs, are investment funds that trade on stock exchanges just like individual stocks. You can buy and sell them throughout the trading day. On the other hand, mutual funds are bought directly from fund companies, and transactions occur only at the end of the trading day. This structural difference impacts how you interact with these investments. When it comes to trading and pricing, ETFs offer real-time trading during market hours. Their prices fluctuate throughout the day based on supply and demand, similar to stocks. Mutual funds, however, are priced once daily after the market closes. This price is called the net asset value, or NAV. You'll always buy or sell mutual funds at this end-of-day price, regardless of when you place your order during the day. Cost is a critical factor for long-term investors. ETFs typically have lower expense ratios compared to mutual funds, which means you pay less in annual management fees. However, you may need to pay trading commissions each time you buy or sell. Mutual funds generally have higher expense ratios, and some charge load fees, which are sales charges when you buy or sell shares. These costs can significantly impact your returns over time. Tax efficiency is where ETFs shine. Due to their unique structure, ETFs generate fewer capital gains distributions, making them more tax efficient for taxable accounts. Mutual funds, on the other hand, may distribute capital gains to shareholders annually, even if you haven't sold your shares. This can create unexpected tax obligations, especially in actively managed funds where the portfolio turnover is high. Getting started with ETFs is more accessible for beginners. You can invest with as little as the price of one share, which could be as low as $50 or $100. Mutual funds often require minimum initial investments ranging from $1,000 to $3,000 or more. This higher barrier to entry can make it challenging for new investors with limited capital to get started. ETFs provide advanced trading flexibility. You can use stop-loss orders to limit potential losses, limit orders to control your purchase price, and even engage in short selling if you believe prices will decline. Mutual funds offer only basic buy and sell transactions. There's no intraday trading, and you cannot use sophisticated order types. This simplicity can be beneficial for hands-off investors, but limiting for active traders. Both ETFs and mutual funds are excellent investment vehicles, each with distinct advantages. ETFs are ideal if you value trading flexibility, lower costs, and tax efficiency. Mutual funds work well if you prefer simplicity and professional active management. The best choice depends on your investment goals, trading style, and personal preferences. Many successful investors use both types in their portfolios to leverage the strengths of each.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.